Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and how all of this impacts our decisions on the best courses of action for your portfolios. Thanks so much for taking the time out of your busy schedules to join us. We are recording this so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, who is usually on the call, she's in school this week learning more about risk and insurance planning. So she'll be back next week. At the end of the call, we'll have a period for question and answers. So if anyone does have a question who's listening, please feel free to ask a question. So HighRock was founded by Paul in 2010 to manage a series of closed-end funds for the Scotiabank, and HighRock is registered with the Ontario Securities Commission. I joined Paul in April to help build our private client business, and we're off to a great start. We've added a number of new families over the past few weeks, and we're talking to many more that are thrilled with the direction that we're taking. Our private client division was established to take advantage of some of the synergies that come with the $200 million that we manage across 4 funds for Scotiabank. We're not brokers, we're not investment advisors or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Now, most financial or investment advisors are not paid to manage money. They're paid to gather assets and find a mutual fund or a third-party manager to place your money with. In fact, many advisors place their clients' money with HighRock. This means that they are paying fees on top of fees. In essence, our private client group is intended to take out the middleman and save our clients money. Now, here's something that's important. Both Paul and I and Bianca, so all 3 of us, have our money invested the exact same way as all of our clients. So whatever we do for all of our portfolios. In fact, you could call it that we say we all have our skin in the game. Our fees are simple and transparent, and that's the way we want it to be. And we want to make sure that that's very clear to our clients. Okay, so as portfolio managers,
Scott, can I just Scott, can I just pause and go back one screen? Just back to that slide right there. Maybe people who are listening and maybe they want to ask a question, I don't know, but the bubble in the bottom left where it says third-party managers, we will use some third-party managers in the form of very low-cost ETFs to get exposure in jurisdictions and geographies where we can't actually manage money directly by picking stocks or bonds, that being Latin America, emerging markets, Europe, Asia, Africa, etc., even some in the US. But very importantly, and some of our clients may have seen our name in the paper last Tuesday, in fact, in the Financial Post, Barry Critchley wrote an article. And really that article focused on that bottom left bubble, third-party management fees. These are called embedded or hidden fees that clients pay when their advisor farms money out to a third-party manager, like HighRock, in fact. The one sleeve of our business does charge those embedded fees. But we are fully disclosing to our clients that embedded 0.08% fee. The new regulations do not require advisors to disclose that fee. So we are going above and beyond the regulatory requirement by disclosing that fee. Just wanted to make that note. And again, that article is in the Financial Post under Barry Critchley.
Okay, thanks, Paul. That's great. And I know that that's something that's certainly very important to you. It's also extremely important to me. And I'm glad you took the time to get in there and tell us more. So as portfolio managers and wealth managers, we also have to be risk managers. And Paul and I have been honing our risk management skills over the past 30, 35 years. So let's talk a little bit today about risk, the things that we consider to be important. And over the next few weeks, we'll try and add some clarity to the risks that we identify, assess, and mitigate. For you, our clients, the biggest risk that you face is that you might not be able to fulfill your goals, whatever they may be. Your financial goals likely depend on making sure that you grow your assets. And if you're dependent on your portfolio for your comfortable lifestyle, then you need to be achieving a level of growth above the annual increase in the cost of living after fees and taxes. If you're still growing your assets and dependent on your employment income to do so, there's risk in losing that income stream, and that would hurt your ability to save for the future. And if you've determined what growth rate you need for your assets, which we do for our clients via our wealth forecast, then the risk is that you underperform your desired asset growth levels, because whatever assets you own have not been appropriate. This is market risk, where Paul and I excel at knowing what assets you should own to provide you with the best risk-adjusted return. So ours is a strategically important role. Knowing our clients' goals, we then have to determine how we will pick assets that provide for the best returns for the least amount of risk taken. For each asset, we need to identify the risk, assess the potential for volatility, build in mitigation strategy, ensure that we are always monitoring and reviewing its progress, and establishing control parameters for ensuring that we eliminate as best as possible any asset that moves outside of our zone of comfort. Our track records speak for themselves. Our models have consistently outperformed the benchmarks over the last 5 years. Simply put, we need to understand the risks associated with the three types of investments that we have. Risks to the ability to generate income, risks to the ability to provide growth, or a combination of the two. So what are the risks that we need to manage? Well, our interest rate's going to go up or go down. Remember the yield curves that we talk about each week? Well, we need to be aware of how different maturities are being impacted as interest rates change, be it 1 year, 2 years, 5 years, 10 years, all the way out to 30 years. Because we have a global portfolio, how do we mitigate exchange rate risk? We know that in times of volatility, investors move away from risky assets into safe assets. Well, the US dollar is considered a safe haven, so owning US dollars in a portfolio can help reduce volatility. We need to know that we will get our principal back when a bond matures, as well that we will get our regular interest payments. If we are buying a company's stock, we want to know that they are following their business plan for growth. Do we have the appropriate balance and diversity to limit large swings in portfolio value? And what are the global economic and geopolitical events that are driving investor confidence, both positive and negative? What are risk-adjusted returns? Simply put, getting the best possible return and taking the least amount of risk. And I'm popping this slide up on the screen, and Paul, you may want to jump in a little bit here too, but this is to give our clients an idea of how we can mitigate risk. Along the vertical axis, we have total return. Along the bottom risk, we have our measure of risk, standard deviation. And you can see the farther out to the right, the risk gets greater. Obviously, the higher it up on the left, the returns get greater. So our goal is to be as up in the top left quadrant as best as we possibly can. And when we devise a model portfolio, we certainly want to be mitigating that risk, but also at the same time getting the best possible return for the risk that we're taking. Paul, do you want to throw in a couple of words?
Picture's worth 1,000 words. That kind of says it all. Everything we do is to dampen volatility and attempt to increase return.
All right. So let's move on and get into some of our themes for 2015 and actually assess the risk of some of the latest developments that we've been seeing. So let's look at the latest economic data. Last Friday, we got a glimpse of the latest U.S. Employment data. The main non-farm payrolls grew by a larger than expected 280,000. The unemployment rate actually ticked higher, but the participation rate increased, which means more people were looking for work, and that's considered to be a positive. As well, more importantly, we saw an increase in the average hourly earnings work level, and by about 0.3%, also better than expected. In fact, the annual growth rate over the last 12 months has been 2.3%, a level not seen since October of 2013. So the U.S. Federal Reserve has been focused on wage growth, which has been rather benign up until now. But if wage growth is sustained, this can be perceived as being inflationary and may have an impact on their interest rate decisions. So we also have to consider the risk of what happens in the future if interest rates start to rise. Now, it's pretty much expected. We've talked about this on a weekly basis. The U.S. Federal Reserve is expected to begin raising rates in September with a 0.25% increase. But as this impacts financial markets, it pushes bond yields. And again, it's something that we have to be aware of. Higher yields mean lower prices. And last week, U.S. bond yields hit the highest level since November of 2014. So the risk here is that as prices go lower, there may be some temporary decline in value. However, there is very little repayment risk in owning government bonds. So long as they continue to pay interest income, which also has little risk, they remain a safe haven. And so when we get equity market volatility, investors will move from riskier assets, like equities, to the safety of bonds. And that will, in fact, improve bond prices. So we got to be very conscious of how these movements occur and when they do, and look for the right opportunities to buy bonds for our clients if we need to. As also we've discussed each week, bond markets are leading other financial markets, and that hasn't changed. We look at what's happened to the S&P 500 and last week with the advent of the employment data, we saw that the S&P 500 broke down through its short-term uptrend line from the beginning of the year. From a risk perspective, of course, we would then expect some near-term potential for higher price volatility. Now, of course, we've been expecting this because we've thought that equity prices were expensive, but we've seen volatility levels now move above recent averages. So our market assessment anticipated this risk. We have talked about this on a weekly basis, and we've positioned our client portfolios accordingly. Okay, so let's talk a bit about what we are doing in our portfolio models. We'll start with fixed income, and as we've mentioned with bond markets, volatility there, we're looking for opportunities. A couple of weeks ago, we took advantage of some weakness, added a small amount of 10-year Government of Canada bonds. We have not added any since, but again, we're certainly always looking for opportunity here. Let's talk about global equity model. Again, looking for opportunities. We have been talking about being patient, and that patience is beginning to pay off as we are seeing opportunities develop. You'll notice breakdown in prices here in the equity market in the UK. We've seen similar breakdown in Germany, off some 10+% from the highs. So definitely in correction mode in Europe. In North America, we are starting to see, as we saw with the U.S. S&P 500 earlier, and also if we look at Canada, we're starting to see some corrective activity going on. So again, looking at these levels and saying, okay, maybe some opportunities are starting to present themselves. We're still patient, but we're still looking for it. Something that we're not looking to buy at the moment, of course, is our Japanese equities. They continue to advance, still holding their trend. And until we see that trend break, we'll probably be standing back from any purchase of this particular asset class. Finally, let's have a peek at emerging markets, because it's another place where we do look to keep our investments not significant because of the higher degrees of volatility, and you can certainly see that here in this slide. But certainly also we're seeing some opportunities develop. So risk does bring opportunity, but we want to make sure that we're being very careful about how and when we do act on those opportunities. In our growth portfolio, I'm going to pass it over to Paul, because he basically is in charge of the growth portfolio, and see if he wants to add anything today.
Thanks, Scott. The same story as the previous few weeks, and quite frankly, is the global growth model as well, or the global equity model as well. But we're still looking for value. Many of the names that we follow seem still overvalued, and we're trying to be disciplined and patient. We did sell out of our entire position in Air Canada stock, which we bought 3 weeks ago. So most client portfolios would have seen about a 0.17% gain over a 3-week period, which was pretty good. And that is, again, a very volatile stock, especially now, and U.S. airlines have been very volatile. So we look to re-enter that trade, but at lower target levels. And other than that, we continue to monitor the players that we look at, and waiting for better entry points on those.
And thanks for that, Paul. But certainly 17% improvement in a small part of the portfolio still has a reasonable impact. But again, talking about assessing risk, obviously seeing such an appreciation over a short period of time, the price going as high as it did, you assess that there's probably a greater risk that we wouldn't be able to hold those prices, and you acted accordingly. And I think that's something that our clients makes them feel comfortable, is that we're on top of this at all times and making sure that we're not only taking advantage of opportunity, but when we assess a situation that looks a little overly risky for us, when we exit it. Okay, that's it for our planned discussion, but we are always looking for participation from our clients and anybody on the call. If they have any questions, we'd love to have somebody ask a question.
What other areas for growth equity are you looking for right now?
For growth equity?
Yeah.
Well, our models are primarily focused on, our growth equity is really focused on Canadian small and mid-cap names. So names that we know really well, that we follow through, either through the high yield market, where we're active every day, or names we've had a history with, et cetera. But we're not, I'd say those are really in our wheelhouse. We've got relationships with CFOs and CEOs, et cetera. We're not really looking for growth equity opportunities in geographical locations where we don't have those significant benefits or advantages over others. So we're not picking growth equity stocks in Europe or Japan or Latin America, or quite frankly, we may do very, very few even in the U.S. because we don't have the same comparative advantage for competitive advantage as we do in the Canadian names. So we really just focus on Canadian small mid-cap names for growth equity.
Thank you.
Any other questions? Paul, there's a question that's come in by email, and if I could just get you to maybe address it. This question is in regard to our investment review committee. And basically, as our clients may know, we have a very special situation where we have employed Witchcrest Compliance Services to provide an independent review for our clients of how we're running our mandates and running our portfolios for our clients. And the question comes in and says, well, who is monitoring the investment review committee? Who is making sure that they're doing the right thing? So maybe you want to cover that one.
Okay, sure, and that's a good question and a fair question at that. So I'd start off by saying, first of all, High Rock Capital's private client division, we're not managing funds. We're managing, as you can see on the screen, separately managed accounts. So that means when you open up an account with High Rock's private client division, you have your own account at Raymond James Custodial Services, and all the securities in there and the cash and anything that's in there, any investable assets are yours. So we have portfolio management software. When we do a bulk trade, it just allocates it to all of the accounts. All High Rock has the authority to do from you is trade the securities in your account. So that's an important thing to note. But because we're managing separately managed accounts and not a fund, we do not need to have an IRC, an independent review committee. Prospectus-based funds or public funds, mutual funds, even ETFs, need to have an IRC. The OSC and the Canadian Securities Administrator mandate that. And an IRC is really formed typically by 3 individuals appointed by the fund manager, and that's an important note. It can either be, usually it's 3 members that are appointed by the fund manager, or it can be a trust company. I don't know of a single one that is a trust company. So as an example, the 4 funds that we manage for Scotiabank are prospectus-based public funds or closed-end funds. They trade on the TSX. They have a 3-member IRC, and the 3 members are all the same for all 4 funds, and they are appointed and paid for by the fund manager, being Scotiabank. So that is common practice across the industry, across the country. So in our case, Scott and I decided we needed something quite different, and conflicts of interest are an important part of it, but for us, we're not really going to have a lot of conflicts of interest. We do have a relationship disclosure information document we give to all new clients. It outlines any potential or existing conflicts that might be there. And what we really think is important is that our clients know that the portfolio composition and suitability of the portfolio is as it should be, as per the investment policy statement that you signed with us. And that's really important to note, that your portfolio is not going to be littered with junk or penny stocks, if you will. And I guess, quite frankly, going back to something you said earlier, Scott, everything we do in these portfolios, these are our mandates, or pardon me, our models, we're doing for our own family accounts. And you know, I take that to heart. I mean, everything I do is for my household and quite frankly for my parents. So in fact, all of our household accounts, all employee accounts, are registered by law as a pro account, which means that when we do trades, we go out and buy or sell Air Canada stock, that all of our clients get filled on the trades first, and then pro accounts or employee accounts get filled second. So that's another important distinction. But just getting back to the IRC, really, we do pay Witchcrest Compliance Services a small stipend on a quarterly basis to report to our clients, the same as any prospectus-based public fund pays their 3 IRC members to report. And quite frankly, I think using Witchcrest Compliance Services was a really, I think, a good move on our part. Jonathan Heyman, who runs Witchcrest Compliance Services, is not going to risk his reputation. He's had his firm since 2007. He's not going to risk his reputation on us being offside on anything that he sees, whether it's a conflict of interest or portfolio composition and suitability. So I think ours is a very strong IRC, but again, quite frankly, we don't even need to have one. We don't need to have one, but we want to have one, and it was our decision to put that in there. Does that answer the question enough, Scott, do you think?
Yeah, I think that's a pretty good answer, Paul. And also, for our clients, they do have, as you said, separately managed accounts, and they will be able to go online or get a statement that shows them exactly what they own each month or online on an ongoing basis in their portfolios. And if they ever see anything that they have a question about, we're available to have a conversation with them and help them understand what our strategy is and why we have that particular situation in the portfolio in our models. So, everybody has it, but if one particular client does have a question, they're more than welcome to send us an email or pick up the phone and give us a call, and we're always happy to engage them and have a conversation.
Scott, one last thing, that's a really good point you just mentioned on portfolio composition. If you had a typical investment advisor and he farmed it out and bought you mutual funds, you would only know the top 25 positions in the mutual funds you owned every 6 months. That's the minimum they have to support and show their portfolios on the mutual funds. And we do that, quite frankly, with 4 funds we manage for Scotia. At High Rock, as you said, every month or every day you can pull up an online statement and you can see your account, you can see exactly every security that's in there at all times. So that is way better disclosure than owning expensive mutual funds.
Well, and not only that, if you owned an expensive mutual fund, you would not have, as a client, you would not have access to the portfolio manager to have a conversation. And as I said, we're always available to have a conversation with our clients. So there's another distinction.
So you're getting institutional management for roughly half the fee.
Makes sense to me. Anyway, I think we've gone over our allotted 30 minutes this week, Paul. So I'm going to cut the questions off at that and say thank you once again to all who joined. Thank you for participating with the questions, and we definitely look forward to chatting again with you all next Tuesday. So have a great rest of the week, great weekend, and we'll see you all next Tuesday. Take care.